From the morning reading, the spider finally pulls back after a 13-day channel. Just one of 9 sectors moved higher on Tuesday. XLE, XLP, and XLB were the strongest sectors, while XLY was the weakest sector. Oil futures fell 36 cents to close at 39.72. Breadth weakened compared to the prior session as decliners led 23.11 to 686 on the New York Stock Exchange and led 1926 to 651 on the Nasdaq. The spider penetrated the 215.31 support low of its 13-day sideways trend, but closed above that at 215.55 or down 0.64 of 1%. This is the first day of any meaningful pullback since the spider broke out of the horizontal resistance on July 8th, clearly making it one of the 30% of the time that breakouts don't test right after their breakout. On the S&P 500 snapshot, that 13-day trading range broke to the downside. For the previous 13 sessions, the S&P 500 has traded in its narrowest range in decades. Today's 0.64% down close broke the range to the downside, albeit modestly. The index did a sharp slide in the first 90 minutes of trading, trended sideways, and then slipped to its 1.07% intraday low at the end of the lunch hour. The afternoon saw partial recovery to that 0.64% negative close. Apparently, oil was again a drag on today's action, with end of the day West Texas crude dropping another 1.37% to close at 39.51. That's the first close below 40 since April the 8th. The yield on the 10-year rose 4 basis points to close at 1.55%. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:09 a.m. Mountain Time, and I'm recording this in preparation for the market day of August the 3rd, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's go ahead and dive into the morning report. This is going to be a bit abbreviated today. I've had to record a couple different times, and so we're delayed in getting this to publishing, so we're going to just kind of cut to the chase today. In terms of the current U.S. broad market indices, are all down just below scratch, nothing of significance. Crude oil is up about 0.81%. Euro is down about 0.25%. Bonds are up just above scratch, and gold is down just below scratch. China is up about 0.25%. Hong Kong about 1.76% negative. Japan closing in on 2% down. Germany just below scratch, and United Kingdom also just below scratch. And macroeconomic reports for today, you had already the ADP non-farm employment, and that certainly will give some insight into what to perhaps expect from the monthly employment report that'll come out on Friday. You also have ISM non-manufacturing. During the market hours, you have crude oil inventories on its regular weekly report. And then looking forward to tomorrow for the U.S., you have the weekly unemployment claims and factory orders, nat gas storage. So all the usual Thursday reports. In terms of normal volatility, what's normal right now is exceptionally low, though the short-term VIX did climb a little bit yesterday. It's up over 12 at a 12.35 now. Skew, no real change, still just above the warning level of 125. IV percentile still all single digits, and the S&P a 9, the Russell a 6, the Nasdaq a 5, and the Dow a 6. We did have, for the first time in over 2 trading weeks, a standard deviation size move put in on the close-to-close basis, and that happened on all 4 of the indices. The Dow, frankly, was just below a 1, but it was like 0.96 or something like that, so I rounded it up to a 1. Obviously, it met the standard of being in that kind of a size move. In terms of the charts, you can see here on the S&P futures chart, we clearly broke down out of that trading range. The question for me is, do we come down and test this area of the prior resistance? And I think that's probably where we're heading. So probably somewhere around 2120 to 2134. Probably have a test of that area. And hopefully then it moves into form another bullish leg and set up another round of new all-time highs. So you end up with just kind of a really slow motion bull flag, as it were, kind of pattern, with so much of it being in the sideways kind of pattern to begin with. In terms of the other indices, they're very, very similar. The Dow, of course, has been doing this diagonal resistance, so more of a true bull flag pattern, and it certainly is approaching its former resistance as well at about 18,060 on the Dow futures. So look for this weakness to probably have a little bit more to go, but then to start to find support, and that support could come quick once those bulls decide that they've had enough of an opportunity of this pullback to be able to find some values. They likely will turn this very quickly. In terms of the NASDAQ is not been in a 2-week sideways pattern, but on the strength of some really good earnings reports has been moving forward, though until just a couple 3 days ago, was still not at its all-time high. So it tickled into a new all-time high, closed just barely into that area, and then immediately had this bearish engulfing and has pulled back. So you'd like to see that the NASDAQ responds to this test and, nominal setting of an all-time high with a bit of a quick consolidation and then a leg up and through that area to truly clear that prior resistance area with some definition. So again, in terms of a pullback, probably just a mild pullback, a few percentage points before the bulls kind of come back in. Watch for major earnings reports on the NASDAQ as opportunities to see this reverse. And then in terms of the Russell largely sideways, but kind of a hybrid between what we've seen with the S&P and then what we saw with the NASDAQ, in that this one's actually been edging up, but still has to get to its all-time prior highs. And then, of course, the last couple sessions has been pulling back. So really, it hasn't broken to speak of these lows. It's just sitting at its trading range lows. And we'll see if we get a little bit more of a pullback perhaps, and then set up another bull flag to continue to move higher. That's probably the higher expectation at this point. This could always, of course, develop into something more significant to the downside, but that really isn't what's in the cards right now from a probability standpoint. But anytime you start to get a pullback, you always have to watch the energy and momentum of that pullback and see, is it setting up for something greater? Don't expect that. In terms of gold, gold has been moving up and is approaching its former all-time swing high set just a few weeks ago. And then also bonds. Bonds have, they did pick up a few sessions ago, but then it has fallen back. It's still basically in a consolidation pattern, so no clear indication here by bonds that they're going to lead the equities one way or the other. In terms of volatility, we've ticked up, but not much. So, certainly this is not some sort of explosive volatility spike, just a nominal increase in volatility from very, very low levels. And let's see, what else might we take a look at? Gold, bonds. I think that's probably good enough for the charts right now. We'll go ahead and move on. Go ahead and go to the daily report. And on the daily report, we started to see some deterioration and changes in the lower sections, not in the upper sections, though. In terms of the market timing signals and so forth, we're still largely where we've been. Intermediate term phase opinion, market phase 3, expectation of bull flags. In terms of the 3 market timing signals, the first one from IBD, confirmed uptrend, that's bullish. The second one, the GMI index, did slip 1 notch to a 5 out of 6, with the buy signal still in place since July 1st. The stock charts, decision point scoreboard, still in the all green across all indices and all time frames of the short to intermediate, but still sitting there with those mixed signals on the long term. Those have persisted and not gone away at all. In terms of position sizing opinions, both models coming in still at 100%. Intermediate term market posture still very, very strong across all 4 indices and further supported by a bullish sentiment line. This is one of the reasons why we're expecting that this really expected pullback is going to be a relatively mild one. The strength of the trend is very strong. And indeed, the hedge warning status is still a 0+ normal with some cautionary aspects. No change in the strategy opinions, absolutely okay. And indeed, we've been waiting for a bit of a pullback to perhaps roll out some put selling opportunities. So get those watch lists ready when you see the signs that support has been found and this pattern is starting to break out from a bull flag. You may want to consider putting on some new positions. In terms of specific warning areas, you see the same 2 low-grade warnings we've been seeing for a number of sessions in the volatility section. Neither one of these, significant. In the trend base, they're all strong bull signals, no signs of warning there. The key intermarket risk aversion indicators, this one certainly did give us a heads up to expect a pullback as it deteriorated over a number of sessions, and currently we have 3 of the 5 flat out risk off, and the other 2 getting ready to cross over. They've started to roll over but have not yet crossed over. From a sentiment standpoint, you have a little bit of the sentiment has been scrubbing off with the weakness, yet that extreme sentiment still is in the upper quartile in the extreme greed area. So again, watching for those reversal patterns. In terms of sector specific, you could see quite a bit of deterioration in the short to intermediate term, with only healthcare and technology at this point holding up as being bullish across all 3 time frames. Also note the ones that are perhaps the weakest, transportation and energy in particular, are weak. In terms of percent change yesterday, you see energy actually had a positive day with everybody else negative. And indeed, for the most part, the higher beta areas were the worst performers yesterday. So risk on money was being taken off the table. And the lower beta areas did perform better, but they were also down on the day, with the one exception being the energy story for yesterday. Okay, let's go ahead and wrap up. As I said at the beginning of the recording, we're coming to the publication a bit late today, so I want to go ahead and get this on the YouTube site. So we'll hit the disclaimers. Disclaimers always. Hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll see you back here for the next session from Falcon Global with our market preview. In the meantime, manage your risk and good trading.